Today, credit is easing while job vacancies boom. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and properties with a distinctively Australian flavour. Well, here we are once again at the end of the month, and so we get the latest financial aggregates from both the Reserve Bank and also data from APRA, looking specifically at private sector credit. And the ABS also today released some interesting data relating to job vacancies, which are, well, sky high. So another very interesting set of information which I want to walk you through now. And so we're going to start with the financial aggregate data. So the data to the 30th of June, which relates to the end of May, shows that overall credit was significantly up again. Actually, this is a 13.5-year high. The annual growth rate for total credit was 9% in May 2022 compared with 1.9% in May 2021. Housing credit was up 7.9% to May 2022 compared with 4.8% in May 2021. Personal credit was down 2.8%, and that compares to down 2.65% last year. Business credit was up 12.9% compared with a fall of 2% last year. And broad money was also higher. Now, if we then look in more detail at the monthly credit aggregate growth, housing overall grew by 0.63% in the last month. Of that, owner occupation grew at 0.65% and investment lending grew at 0.6%. And it's worth noting that investment is still considerably growing stronger compared to owner occupation in terms of the relative change. Personal credit was just slightly higher, but business credit was up 1.32% over the month. Now, of course, these monthly figures are very volatile, business in particular, but it does seem to me that based on my own surveys, a lot of businesses have been using credit to deal with cash flow issues rather than investment issues, but we'll see how that translates ahead. Overall, credit was up 0.82%. That's slightly down from last month. And broad money at 0.75% was relatively strong, but not as strong as it was back through the earlier part of the cycle. The more reliable annual growth rate shows that overall housing credit was at 7.93%. Owner occupation lending was at 8.86%. And investment lending is at 6.09%. And it's interesting to note that owner occupation lending is already beginning to ease back, but investment lending is still a little higher. It's partly there because there's a lag, of course. Remember that the first interest rate hike started at the beginning of May, then another one at the beginning of June, but applications take a few weeks to flow through, so we're going to see this begin to drop more substantially ahead, in my view. Personal credit was down 2.84% over the year, so still relatively low, but remember this doesn't include buy now, pay later, and other forms of credit outside the official statistics. Business credit was booming at 12.92%, and this, I think, is due because of working capital needs. The aggregate credit growth overall was 9.05%, and the broad money is 10.41% higher than a year ago, but you can see there that we're still significantly lower than the nearly 13% that we hit back in 2020. And we'll also look at the 3-month because the 3 months give you a better view of the forward view. Housing overall is beginning to slide now, not dramatically, but enough to be noticeable at 1.83%. Owner occupation lending was at 1.84% and has been sliding since June 2021. While the growth rate for investment lending is still slightly on an upward trajectory, although we expect that to ease back too. Personal credit at 0.25 is a little stronger than it's been, and business is slightly stronger too. Now let's look at the ADI statistics from APRA. This relates to the balances held on loans in the banks in Australia. And they say that the stock of Both owner-occupied loans and investment loans rose. The proportion for investment lending continues to collapse down to 33.1%. And the overall balances at the banks are $1.994 trillion. So we're knocking on the door of $2 trillion of outstanding household debt relating to housing. Now, if we then look at the change over the month, owner occupation grew at 0.64%. Lending for investments grew at 0.5%, which was exactly the same as last month. The total was 0.59%, which was just slightly up from last month, but still quite a lot further down from where it was in December and January and February 2022. And if we look at the selected portfolio movements, this is sorted by owner-occupied loans. We can see that CBA, National Australia Bank and Westpac hold the largest share in terms of the portfolio movements. Macquarie Bank follows and by far made the most lending for investors. And it's interesting to note that there was some investor activity. ANZ was also very active in investor land, but not so much on owner-occupied land. So once again, it seems to me we are seeing quite different strategies playing out across the different lenders in terms of their approach. Some more conservative, some more aggressive, some less willing to lend for investment properties, others very, very willing to lend for investors. Now let's turn to job vacancies. The ABS said that there were 480,000 job vacancies in May 2022. That's 58,000 more than in February 2022 and more than double the vacancies in February 2020 at 227,000, according to the ABS statistics today. And the ABS said that the number of job vacancies rose by 14% over the 3 months to May 2022 to almost 500,000 jobs. This reflected increasing demand for workers, particularly in customer-facing roles, with businesses continuing to face disruptions to their operations as well as ongoing labour shortages. In addition to a higher number of vacancies, the percentage of businesses reporting at least one vacancy also increased. A quarter of businesses reported having at least one vacancy in May 2022. This rate was more than double the pre-pandemic level in February 2020 at 11%, which highlights the extent to which businesses are finding it more difficult to find staff. The large growth in vacancies through the pandemic has coincided with a decline in the number of unemployed people. As a result, there was almost the same number of unemployed people and vacant jobs in May 2022, a ratio of 1.1 unemployed people per vacant job, compared with 3 times as many people before the start of the pandemic. The largest growth in job vacancies was in Victoria, which increased by 18% over the 3 months to May 2022, followed by New South Wales at 12%. While job vacancies were considerably higher than before the pandemic in all industries, the extent of quarterly growth varied between industries. The industries with the highest growth in vacancies over the quarter were retail trade at 38%, information, media and telecommunications services at 18%, and arts and recreation services at 16%. Vacancies in the private and public sectors both increased over the 3 months to May 2022 at 14% and 9%, though private sector vacancies were still much higher than before the pandemic at 117%, compared with 65% in the public sector. So there's a very interesting set of readings here, insofar that we know there are plenty of jobs out there, but we also know that the number of workers actively seeking jobs is rather lower. Now the question is, what is driving that? Well, that's partly, of course, more older people deciding to retire and giving up looking for work. Plus, of course, I think some being quite picky on the type of work that's available and the wage point at which they want to engage. I think personally the answer is that if wages were to increase, we might suddenly find some of those job vacancies getting filled. But of course, businesses are resisting that in the high inflation environment. But this is another sign of stress in the economy. And looking ahead, as the inflation forces begin to build, as credit gets tighter because interest rates rise, my expectation is that job vacancies might start to decrease. But we'll see. It'll take a few months for this to flow through to the bottom line of the data. As always, we need to continue to watch and monitor what's going on, and I'll be doing that, of course, as we progress. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.